Hi, everyone. I'm Destiny Fernandez, the marketing manager at Catalyst Funding. We want to thank you so much for joining us today on this call and keeping an eye on the ever-changing market. Before we dive in, I want to remind you that this webinar is being recorded. You will be sent a copy via email tomorrow. And if you have any questions while we're on the call about any of the slides that we're covering, or just questions that you may have, please write them into the box and we'll ask our experts at the end. If you have a very deal-specific question, we may direct you to one of our fully licensed loan officers so that they can assess and talk to you directly. Next, we want to make sure that you remember we love providing this monthly webinar as a tool for you to assess the current market and future market. However, we want to note that Catalyst and any of our associates or guest speakers are not liable for any investment decisions you make hereafter. Please always conduct your own due diligence before moving forward with the deal. And again, feel free to contact us. We pride ourselves on being trusted advisors and have fully licensed loan officers that are happy to help walk you through your deal. One last thing before we get started. We will have a lucky winner on our call today. As you know, we do half off our hard money processing fee at a raffle at the end. So make sure you stay till the end to be eligible. And I'd like to introduce you to two of our guest speakers today. These are Catalyst Funding industry experts. If you're joining us for the first time, I'm really excited to introduce them to you. If you're a regular, then you know them already. We have our Director of Lending, Jeff Johnson. Jeff handles all of our lending operations in Catalyst, and he aims to provide all of our clients with excellent, top-notch service and a smooth lending experience. Jeff has over 20 plus years of experience and insight, and that's what he's going to be sharing with us today. We have I would say a special guest. Austin doesn't normally join us, but he has in the past. Austin is our sales team manager. He has been with our team since 2017. He's a fully licensed loan officer, and he's actually an investor himself. And I say it like that because I'm always so shocked at how gung-ho Austin is. He's young and he's getting out there. He's getting all the deals. So props to you, Austin. So he'll be speaking to you from both the lending experience as well as an investing perspective. Next, I want to kind of pass the torch. Who wants to take it? We want to tell you a little bit more about us if it's your first time joining. Jeff or Austin? Who wants to jump in?
Austin's all over there.
Okay, great. Jump in.
Yeah, appreciate the introduction, Destiny. That was nice. Here at Catalyst, we are a one-stop shop for hard money, conventional and non-conventional financing. We are a lending company built by investors for investors. We've been involved in thousands of transactions. We've flipped hundreds of houses. We have a very large rental portfolio in-house. We do have 5-star reviews across all social media platforms, so you can go do your research if you haven't worked with us in the past. Like I mentioned, hard money, conventional and non-QM. We do have 30-year fixed non-QM products. If you're looking to get Airbnb properties, if you're looking to bunch multiple properties into one loan, we could offer that as well. We do also offer primary homes for primary properties. If you're wanting to purchase, do a cash out refinance to continually fuel your investments, we can help you with that. Our hard money loans do start at 6.99% and 2 points. If you're a flipper, it starts at 9.99% and 1 point for our VIP flip program. We do have best in class pricing on non-QM loans, which are right where conventional interest rates are right now. So if you don't qualify for a conventional loan, definitely reach out and see what we can offer you on the non-QM side. And as I mentioned, we do have the Airbnb loans, which is a no income doc loan. There's no debt service coverage ratio, so you don't have to have the property leased. And we do have 30-year fixed products for that.
Yeah, I was just going to add on, we've been doing a ton of the non-conventional stuff or non-QM lately. So those are loans that mostly for investors, or let's say you don't report all of your income, maybe you're self-employed, not report, but you write off a lot of stuff, so you don't qualify for a conventional loan. So we're doing a ton of those deals, non-conventional, or investors maybe that have already tapped out all of their conventional loans and they want to keep going. That's probably been the biggest growth spot in our portfolio as far as deals we've been doing. There's a ton of non-QM stuff.
Yeah, or if you're looking to hold properties in a company name. I know some people, even if they qualify for conventional financing, if you just want to put properties into an LLC, then that's going to be the product for you as well.
Yep. So I wanted to introduce our guest speaker. His name is Jason Bible. I met Jason, I think it was like 2015 or 14. It was a long time ago. We had just started lending, and I met Jason at one of his events. Very approachable guy, very knowledgeable, very smart. I don't know when you got started, Jason, but why don't you tell everybody a little bit about yourself, about your company, what Mr. Texas Real Estate is all about.
Yeah, we started full time in 2013. Before that, I was just buying single family houses to rent it to flip. So in 2013, we started a company called Houston House Buyers. And the first couple of months, we bought 6 houses. And then the following year, in 2014, we bought 67. And then 2015, 2016, we were doing over 100 houses a year. So we're buying a lot of stuff, a lot of wholesale, a lot of flip. We kept a couple here and there, but mostly it was a wholesaling and flipping company. I sold that particular company in 2018, and then started Mr. Texas Real Estate in 2018. And we're a buy and hold company. So we do Airbnbs, commercial real estate, still in single family rentals. We'll flip one every now and then, but we're typically in commercial and residential on the long-term hold side. We bought this building in the middle of COVID. Everybody told me we were crazy. And in any case, this is the Texas Real Estate Investment Center. It's a business incubator for real estate professionals. There's a whole bunch of real estate folks that share this building with us. We're hoping to open up a couple more of these across the country. But yeah, we've done just about everything. We run a mastermind group out of the office here in Houston. We have about 100 members, and when people join our team, we go out there and buy real estate. So if someone's looking for a little bit different flavor of real estate education that really focuses on doing, that's really what we do. We were a part of a lot of real estate education groups where they had good music and great vibes, but nobody was really doing anything. So we did something a little bit different. So if you're going to join our group, we're going to get you out there and get you to buy some real estate. So our success rate today is about 90%, and our sign up, our renewal is about 86%. So when people join us, they kind of don't ever leave because they're getting the results they want. So that's us.
Awesome. So where is the location at? Where is the center?
I'm at 290 in Hollister, which is between on 290 between 610 and the Beltway.
Okay. And so I was reading in your bio down here, you have a radio show. Is that correct? You still doing that?
Yeah, we have a nationally syndicated radio show since 2016. It's also a podcast. Wherever you get podcasts, it's available there. We're actually starting a handful of new shows here in the next couple of weeks, but that'll just be podcast only. But yeah, I did a radio show this morning, and we're on in Houston. We're on every day. In New York, New Jersey, and Southern California and Nevada, we do a weekly show on Saturday or Sunday morning. So yeah, kind of funny. Somebody said, hey, you ought to be on the radio. And we had a radio station here locally that reached out to us, and we knew nothing about radio. We learned real quick. So that's kind of how that all started. We wrote a book called Mr. Texas Real Estate Reserved. That book came out last year. It was our experience talking about what happened before COVID, during COVID, and after COVID. Book number 2, which is called Complete Real Estate Investing, will be out in August. So we write books, do radio, we do a lot of speaking events. So we're kind of out in the community, and we're pretty active. So
very nice. So if they wanted to search for your podcast, what is the name of it where they can type it up?
The best place to find it, it's like I said, any of the big podcasting services, the Texas Real Estate Radio Network.
Okay, very cool. Well, thanks for joining us. Very happy to have you here, and looking forward to your insights.
Yeah, thanks for having me on, guys. It's great.
Of course.
Awesome. And for anyone that is just now joining us, you had quite a few. We will have Jason's information at the end so that you guys can reach out to them. We'll have their email, their website, and their phone number posted for you.
All right. So we always hit this chart because I think it's very important. It is the housing starts data. It goes all the way back to the 80s, and it shows basically any new housing units that were started for being built since then on. And the prices have been so high lately. There's a lot of factors to that, but one of the biggest factors, in my opinion, is just a lack of inventory. And if you look at the last 10 years or so, from 2010 to now, that is the lowest 10-year decade, starting from 80, 90, I'm sorry, I'm sorry, this goes all the way back to 60. I'm sorry, my vision isn't very good. So 60, 70, 80, 90, the last 10 years, that is the lowest 10-year period. And so that, in my opinion, is really a large piece of why we're seeing such high appreciation. They just weren't building any homes or wasn't inventory for the last 10 years. Now you can see it's starting to increase, and hopefully over the next couple of years it'll be a steeper climb. But this is something we always showed a little perspective, just how few houses were being built over the last 10 years relative to the rest of the last, I guess, 60 years. Next.
Yeah, go ahead. This is the real estate crash. So everybody talks about how, oh, there's a real estate crash coming, there's a real estate crash coming. I said, we're already in one. A lot of folks forget there's a supply and a demand curve. The supply side has collapsed. And I've got a chart somewhere. Back in 2015, we would run about 1.5 million houses available for sale in the United States. And that was a pretty healthy market. Still a seller's market, but still a pretty healthy market. We're now down to 300,000. So wow. We had a 70% collapse in supply. And I heard a presentation by Gary Keller over at Keller Williams. And he said, at the current rate of construction, it will take 18 years to meet demand. So it's just not coming back anytime soon. Part of that has to do with some of the stuff at the CFPB and how they put additional regulations on local and regional banks for funding developers. So part of this is done through legislation. So it's just not going to, all of a sudden, one day, Pulte's not going to wake up, buy a couple of thousand acres, and then start throwing homes up in Houston. That's just not how it's going to resolve itself. So this is what's really driving a lot of pricing, just because there's no homes to buy.
So do you think, because I hear what you're saying, but I also think it's very localized with regards to regulation. I don't know if you think there's a big difference. So like the ability to build a bunch of homes in Houston, Dallas, wherever here is very different than the ability to build homes maybe in other more regulated areas. So if you think that there's a supply problem, and I agree with you, but do you think it can be, I guess, mitigated easier in certain markets?
Possibly, but one of the challenges we're dealing with in all markets is labor and supply issues. I just bought another apartment complex last week. I bought a 34 unit and needs a full rehab. And the problem we're having is, something silly like LED can lights. We order, a couple hundred of them from Home Depot and they show up the next day, right? Well, they're so short, we're not putting incandescents in these properties. Windows are a nightmare. Like, you got to get windows, you're waiting 6 months, somewhere between 4 and 6 months. And that's even at the volume we buy at. I had a buddy of mine that was at the builders conference, and a couple of these big builders are buying warehouse space, and they're writing $1 million checks just for distributors to put stuff in their warehouse when they're ready to start building with it. So there's a lot of, now I do agree with your point. Hey, it's easier to build homes in Houston, Texas than it is in Southern California. But some of these things are structural, like the finance issues, like the supply chain and labor shortages. There's just not enough bodies, and it's so expensive now to build. That's why you're seeing the median new home sales prices over $400,000. We can't build affordable homes anymore. So that's one of the other challenges we're dealing with. A lot of these houses that are being built are move-up buyers or folks that are buying essentially $500,000 house.
So when you say crash, because what you're describing is if there's not going to be enough supply to hit the market anytime soon, that tells me prices are going to keep going up, not down. So when you say crash, what are you referring to?
So in a classic economic model, right, there's supply and there's demand. So whenever people talk about a real estate crash, they're always talking about demand. Are there enough buyers relative to the number of houses? What I'm saying, we have a crash in supply. There's just not enough houses. So what's that causing? Prices to shoot through the roof. Right. I read a report this morning. New home construction, which essentially is new home sales, is down 17% month over month, which is 17% in a month, which is crazy. Wow. So this data you guys are seeing right here this is despite home builders' best efforts. Like, they just can't get units out the door. But But the other thing you're going to see, Jeff, and a lot of the data is now we're starting to see reduction in sales. So when people read that data, they go, oh, there's fewer homes being sold, ergo prices are going to come down. And that's not the case. Fewer homes are being sold because there's no homes to sell.
Correct.
So, and prices are going to keep going up. So there's going to be these really weird economic reports where people go, oh my God, sales are down, but prices keep going up. And I'm like, yeah, because we're running out of houses to sell.
All right, next slide,
Go for it.
please. Thank you, Destiny. All right, so this is a little different. I added this on here because we always talk about it, but I actually found a chart yesterday that gives it some context. So it starts back in I guess we'll call it 90-ish, and it's the same. The top line is the same stats on new builds, but that line from the bottom to the top is population growth. So it shows how even though the homes are not being built, right? You see the crash, and we just talked about how there's so few homes being built. The population is going up significantly. So just to give you an example, I was looking at it. So in 94, there were 260 million people in the country, and there were about 1.4 million housing starts. Today, there are, that was in 94. In 2022, there's 320 million people and 1.7 million housing starts. So the population is going way up, but the housing starts are not that much, right? And over the last 10 years, it's been even worse. I think they average right around 1 million housing starts, and the population was in the 300s. So if you take the 300s of where the population is, and then like averaging like 1 million housing starts relative to where we were in 94, where we're doing a lot more than that with less people, it kind of exacerbates what we've been talking about and shows you how we just have too many people and not enough houses being built. Next slide, please. Awesome.
So this talks about national data in the housing market. So homes for sale on average found a buyer in 15 days, which is the fastest pace on record during the 4-week period ending May 8th. So just a couple weeks ago. Pending sales dropped 6%, which is the largest decline year over year since June of 2020. So many buyers who haven't been priced out by the increased housing costs have been rushing to buy homes before they become even more expensive. And not only with the increased value of the houses are causing them to be more expensive, but the increased rates are also adding up to get to the next stat here, where it shows that the typical home buyer's mortgage payment is now $24.27 on a national level, which is a record high. It's up, what does it say, 44%. Yep, from $16.85 a year earlier. Now here in Houston and California and different markets, you'll see that that's going to be higher, but on a national level, it's up 44%. So the median home price is up 17% year over year, which is the biggest increase since August, to now a record of almost 400 grand. So 397,000, which is what you can see there on the graph in red for where the median home price is. Now the share of homes for sale with price drops have shot up to a 7-month high of 16%, which in the article it went on to say that this is the largest annual price drop since April of 2020.
Yeah, I read this article. That middle bullet point to me was pretty crazy. If you think about the mortgage payments going up 44% year over year. So I mean that's coupled with higher prices and interest rates. The Fed's trying to finally play catch up by raising rates, and so when you couple those two factors, payments are going up quite a bit. 44% a year is a big number. I think as far as like leading indicators, things that I read in the article, they said Google searches for like homes for sale are down 6%. The requests for home tour is down like 19% over the last 4 weeks. So I think people are finally starting to, I don't want to say give up, but they're finally starting to lose interest when you factor in the rates are higher and the prices are so much higher. That demand is starting to calm down a little bit. It's basically gone from just a crazy market to somewhat a little more normal. But still, I was blown away by that middle stat, that 44%.
Jeff, I'll make 2 quick points here. On the one in the middle there that you had mentioned, I read a report last week that in Texas, it's up almost 90%. When you add in taxes and insurance, because taxes, when you sell the house, right, you're now, it's all a new homestead. So taxes are up. And the reason insurance is up because construction costs are up 20% year to date. So even though you may not have a big hurricane year, your insurance premiums go up just because the replacement costs, the construction costs are so much higher. So, and the second point I'll make here, you've got to remember that median is not average. So average is an average of the entire data set. Everybody knows what average is, right? Dump it all in, divide it by the number of observations, boom, that's average. Median is the middle number. And why that's important is that means 50% of the homes in the country are appreciating less than 17%, but that also means 50% are appreciating more than 17%. So in some markets, like I buy a lot of stuff down in Surfside, Texas, we're at 30, 40% a year appreciation. Absolutely bananas.
It's
There are
crazy.
some markets that are insanely hot, and there are other markets that are 7, 8, 9, 10%. So keep that in mind kind of when you're looking at some of this data. It's like, oh yeah, it's only up 17%. I'm like, no, there's 50% or is greater than 7, which 17% is a crazy number. So,
yeah. For reference for everybody, I think 4.5 is like the average. Like 4.5 appreciation is like a normal market, normal year, whatever you want to call it.
So I'll tell you what we tell our investors right now. Every house you don't buy costs you $5,000 a month in appreciation. These things are appreciating almost 60 grand a year. Every house, so when you get, and you guys work with investors, right? You guys are investors too. You know, somebody walks in and goes, oh my God, the house needs a repipe and it's 5 grand. I want to do the deal. I'm like, bro, that's 1 month's worth of appreciation. Who cares? Who cares? Just buy the stupid thing, get it fixed, move on to the next one. Because if you pass on 10 houses in a year, that's 600 grand in appreciation. Like you gotta buy as much of this stuff as you can, and it's not stopping. I mean, you take a look at your numbers from 2020, 2021, and 2022. They're all greater than 15%. We're gonna hit 20% this year, and we're probably gonna hit it again for the next 3 years. So it's like, just buy the house. The cash flow, buy it.
Yeah, we have a lot of folks. Sorry, Austin, just real quick. We have a lot of folks. To your point, they see the value in the real estate and appreciation, and even with rates being a little bit higher, because there's so much equity, they're pulling equity out of their residence or other rentals to go buy other property, right? Because if you got a property appreciated in such a high level, you can pull cash out, go get $50,000-$60,000, use that to buy 2 or 3 houses. Yeah, okay, maybe your mortgage payment goes up a little bit, but when you think about it, 10 years from now, if you hold on to that house, in the grand scheme of things, how much wealthier will you be if you go ahead and buy those 3 houses?
Well, and this is the other thing I keep telling everybody, we're in a recession. Like we had a negative GDP print last quarter. In fact, I got the revision number yesterday. They thought it was negative 1.3. It's actually negative 1.7. If you look at the current stock market, a lot of that has to do with retailers. Walmart got killed, Target got killed. Gap is down 80%. So retailers are getting shellacked, which means that the economy's in a recession. We're just waiting for the Fed to say at the end of, right at the beginning of Q3, when we get the numbers, we're going to be in the middle of recession. And there's one thing that we do for the last 200 years in every single recession. We lower rates. So rates are coming back down. So people are freaking out about interest rates. I'm like, buy everything now. Don't worry about what the interest rate is. Because in 18 months from now, you're going to refi. And we're going to be back to 2 and 3% mortgages again. That's the only way out of recession.
I think so, huh? So you think that because I have seen, I know what you're saying, and I believe you when you say that with recessions come lower interest rates. But if you look at the inflation rate relative to the interest rate, it's so out of whack right now. You have to pick your poison, I guess. So you think that they will choose no recession versus inflation? Because if you don't raise rates, you're going to get inflation.
Well, here's where it gets interesting. There's a lot of white papers out there on the new belief that this economy is so complex that raising rates isn't going to do anything. Like raising rates will destroy the economy, but it won't stop inflation. Because if you look back in the 70s and 80s, that economy was pretty, I mean, who was a superpower in the 70s and 80s? The United States. Japan really had to started becoming powerful until the late 80s, early 90s. China was essentially a farming culture. There was nothing going on in China. Europe was Germany, and they were just getting back on their feet. So there was really nobody else in town in the 70s and 80s except the United States. So what do? We raise rates, which pulls liquidity out of the marketplace into bonds. So that stops inflation. However, now it's a completely different animal. Like this is a completely different economy. And I think we're headed right into a recession in an election year. We got the midterms coming up. And the Fed has one of two things they can do: raise rates so try and fight inflation, or lower rates to fight the recession. And I guarantee you, given the current administration, which one they're going to pick, because lowering rates and fighting a recession is much easier than fighting inflation. And I also I'm starting to believe in the camp that maybe we can't fight inflation anymore. There's just too much money out there. But we'll see.
You got to send me those white papers, or at least one or two of them. I'd be curious to read them.
I'll shoot you over the last presentation I did. And I'll see if we got a recording of it somewhere. But I talked a little bit about it in the last one I did. But I'll at least shoot you the PowerPoint and see it.
Appreciate that.
Yeah.
All right. So this next one.
What is inflation currently at? It's like 8.5% or so.
Yeah, it's like 8 or 9%. But the problem is like every administration changes how they measure the CPI. So like Bush changed it, Carter changed. So it's hard to look at it over a long period of time. If you go to Shadow Stats is the only one that will show you the 1990 aggregate, and those are kind of close. But also the way they measure inflation, I think, is stupid. So that's part of the problem, right? But I mean, you guys know, this is how I measure inflation. What is an old fashioned going to cost me? Like old fashioned used to be $10, now they're 15, now they're 20. And it's not even top shelf whiskey, right? And it's like, last night I went out with a couple of friends. We had 4 or 5 drinks. No, we probably had 3 or 4 each, and an appetizer. It was $300. It was $100 a head. We were up for Mission Whiskey over in the Heights. It's not like we were at Seasons 52, right? And I'm like, this is getting ridiculous. It's just getting out of hand.
No, 100%. And that's why the living cost back in the 80s, the living cost was calculated into inflation, like, food cost, living cost, energy cost, and they took that out of the calculation. So whenever you factor that back in, inflation should be around 16, 17%. And we're currently at 8 or 9%. And the interest rates back then, when inflation were that high, were 17, 18%. So I always ask people, why aren't we there right now? So whenever people are always skeptical on getting into properties with the current interest rates, like we're still at historic lows, which we're going to talk about in a few minutes. But it just blows my mind. And one other thing that I was going to say is a couple of years ago, whenever I was working with people, investors would back out of deals because an appraisal came in, $5,000, $10,000 low. And, people are kicking themselves now, and we're still in the same environment. Like as prices continually increase, I still see people back out of deals just because an appraised value comes in a little bit lower than expected at times. So it's
you guys want to hang out with some really depressing investors? Go find the landlords that convert them to owner finance.
There you go.
Those are the worst guys at the bar, right? You're sitting there and go, oh man, I converted my 50 house portfolio to owner finance. And you just look at them and go, I bet you're feeling really bad about it. He goes, yeah, because I look at what they're worth now. I should have kept every single one of them as rentals. And I'm like, or you get rich in real estate's appreciation. That's it. It's not from anywhere else. So as soon as you get into owner finance and stuff, like you just lost the best advantage that you had in building wealth in real estate.
100%.
All right, so on this one, the next slide is titled, it's from the Wall Street Journal, it's titled Home Buyers Are Finding Ways to Take the Sting Out of Rising Mortgage Rates. So more borrowers are paying upfront fees and considering ARMs to lower their monthly payments to combat what we were talking about in the last slide. Applications for ARMs have doubled over the past 3 months. For much of 2020 and 2021, ultra low mortgage rates helped Americans offset a sharp increase in home prices. The average rate on a 30-year fixed fell below 3% for the first time in July of 2020 before bottoming out at 2.65 in early 2021. That is not where we are right now. And then lastly, borrowers in April paid an average, this is the interesting part, borrowers in April paid an average of $3,100 in discount points in loan origination costs. According to estimates from the National Association of Realtors, that is a 31% increase over last year. So basically what I'm saying is two things. One, they are looking to get those lower rates. So what a lot of folks, and I read the rest of the article too, what a lot of folks are doing, they're paying discount points. You're paying a little bit upfront, like just regular buyers, right? These aren't investors necessarily. These are just your average citizens trying to live in a house. They are most of them are paying discount points up front because they're plan on holding on to that for a long time. So it's a little bit of money up front. You spread that over the life of the loan with a lower interest rate. It becomes a much better deal. The other thing is they're doing ARMs and hoping that maybe they can refinance, and they aren't like the ARMs of old. Usually much longer holding periods on those set fixed rates. But they're buying ARMs in hopes that maybe they could refinance down the road if rates do go back down, right? One thing I thought was interesting, because a lot of people, when they hear ARMs, they harken back to the days of the financial crisis, like 07, 08. In 2005, any idea what percentage of the mortgage market was ARMs? Anyone want to take a guess?
I can't imagine it was that big. Probably less than 20%.
50%.
Really?
50%.
50% origination is probably ARMs. That's nuts.
In 2005, 50% of all mortgages originated were ARMs. That kind of gives you and they were typically 2-year ARMs, 2-3-year ARMs, and they were going to shoot right up as soon as they hit that spot. Now they're way more regulated. In January of this year, that number was less than 2%. So there just weren't a lot of ARMs out there, but like I said, they're starting to go up quite a bit. A typical ARM rate now are high 3s to low 5s, which is still very, very good. And it's about the spread between an ARM and a fixed right now is about a 1/4 point to 1.5 points, depending on where you get it and what you get. So there's a little value if you want to really keep that mortgage payment low and your plan is to refinance down the road or sell it. But just there's a lot of folks paying a lot more upfront costs now to keep that rate as low as possible.
Yeah, and just to add on to that, just last week, I can't tell you the reason as to why, but I was pricing out 30-year fixed versus ARMs, and the 30-year fixed, as of it was one day last week, the 30-year fixed was actually a lower interest rate than what the ARM was, which was surprising. And just so people understand, investors, like there's no par rate right now on conventional loans. So just to add to what Jeff was saying, the investors that are buying these mortgages are wanting that upfront fee, and this kind of supports what you were saying, Jason. They're wanting that upfront fee because they can see that it's going to be a good chance in the future that they're going to be refinancing later when interest rates drop. So that's the reason as to why you're not seeing any par pricing at the moment.
Well, there was a real interesting article that popped last week, and I'm not an expert in mortgage-backed securities because MBS is what really kind of determines the rates and what these things are valued at. But there was a real interesting article where we saw a 25 bip drop, not because of change in rates, but the fact that there was so little demand for mortgages. So one of the things that I think investors kind of miss is no one holds their own notes, right? They immediately get packaged up and sold. But you've got to sell those notes. And the only way to sell notes is to create notes. So the only way to create notes is to have consumers going out and buying houses. So I think it was National Wholesale Mortgage or one of the real big companies dropped their rates 25 bips just so they could get some more notes in the pipeline so they could then go sell them. Because I think you guys are right. I mean, no one's really making a whole lot of money even with these rates up. They make money on the processing and selling the notes. So you got to get new notes in the door or you're not going to make any money. So we're seeing these little, like you said, I think the reason there was that little dip in the 30 below the ARM is because they're like, we need more 30-year notes. And the best way to do that is drop that rate a little bit. So at least that's my guess. Like I said, I'm not an expert in it. It's just one of the things, one of the little trends I'm following right now.
All right.
So the 30-year fixed mortgage rate currently in May, we're at 5.28% for owner occupied. This is the national average for owner occupied rates as of May. Last month, Jeff, correct me if I'm wrong, but last month was right at the same as like 5.2 2.27 or something. Right?
Oh, some feedback.
Can you hear me okay?
I can hear you, guy. Okay.
So yeah, so it's really hasn't changed over a month. Yeah, I'm getting that feedback too now. But anyways, last time, whenever we were talking about inflation, I just wanted to touch on this point again. Last time in the early 80s, rates were above 18%. You can see there on the graph. So I asked people, why aren't we there now? Whenever you're factoring back in that, the cost of living that used to be calculated then. So locking in for 5 to 6% right now, honestly, is amazing if rates were to continue to rise. Now, to Jason's point, to your point, Jason, if rates do drop lower, then you refinance, right? And you capitalize on the interest rate there. But if the rates were to go up, investors are going to have to increase their rents to offset the increase in the mortgage payment. So getting locked in now can really be beneficial for increased cash flow in the upcoming months or years if the rates were to rise. And again, if they were to drop, then you just refinance. I just hear so many people that are that don't want to get into the market right now just because the recency bias of where interest rates were very recently. So anyways, that's my take on that.
Yeah, I mean, look at the chart, right? Like you look at the bottom. I mean, yeah, we're slightly above the lowest it's ever been. But if you look relative to the rest of, I don't know, since this chart started, it's not even close.
Yeah.
Like the potential for it getting better is not that much relative to the potential of getting worse. If you look at the downside is a lot higher than the upside, in my opinion.
Yeah, if it goes down, it's going to go down what, 2-3%, right? I mean, like absolute best case, you can't really get too much closer to zero. But to your point, Jeff, the downside of it going up is tremendous. Yeah. So that's why I always try to talk people off the ledge of people who are like, I don't want to invest right now. It's like, just get into the game right now while you can. It's better than your cash just sitting on the sideline.
Well, here's what I'll tell you, the real take-home messages on this thing. Those gray bars are recessions. And if you look at the white portions in relation to the previous, which is an expansion. It's really what there's recessions and expansion. So what the real take-home is, what do you see the rates do after every single recession?
I see where you're going with this. Yeah.
For every recession, rates go down. So we're heading to a recession. Guess where rates are going? Cotton Mattis came out this morning and said rates are going down in 23. I don't care what anybody says. We're going to be in a recession. Rates are going down. And so that's that chart, which goes back to, that's 80. I can't see the bottom, but I'm like, that's 84. So that first gray bar is sometime in the 60s. So
that first gray bar,
you've got like 70 years worth of data here that says every time there's a recession, rates come down.
Yeah, sorry. So the chart, I don't know why we can't ever get the bottom up. It starts in 1971, the first chart. So that first little recession there is probably early 70s, and then the one at the top with the rates, that's early 80s.
Yeah. So what happens after every recession? Rates go down. You look at that and go, man, give me a recession so rates can go down. I can refile my stuff.
Yeah, I'm curious to see how everything plays out with policy and whatnot. Upcoming meetings.
All right. So here we go. So Houston, I'll cover these stats, and then Jason, since you are here, feel free to chime in. So like I said, single family home sales were down, or I'm sorry, statistically flat. They were down less than 1%. Days on market dropped from 40 to 33. Total property sales were flat. Total dollar volume increased 14%. So if your sales are flat and your volume goes up 14%, what does that tell you? Prices are going way up. Single family median price increase over 16% to a record high of 343. And then the average price rose almost 15% to 426. That's the highest it's ever been in Houston. And I think last month was the first month that ever broke 400, and we're already at 426. Now, there was a couple things that I thought were interesting. The rents, for you guys that are buy and hold investors, rents were up to $21.64, And if you, what is this? This is April. So if you look at this time last year, you know, I don't have April here in front of me, but I know in May it was like 1960. So it's, you know, rents have gone up. This is May of last year. Rents have gone up basically a couple $100 a month. So, you know, for those of you that already bought those properties, your payments already locked in. Your taxes are going to go up obviously a little bit, but you haven't done anything, and all of a sudden your cash flow just went up $200 a month, minus a tax increase. There were two other things I saw that I thought were interesting. Even though the sales slowed down, if you look at a year to date, we are 7% ahead of last year. So total units sold, we're still set. Last year was a record, most ever units sold. And we're still 7% ahead of last year. And if we say flat the rest of the year, then obviously we're going to crush the previous record. And then I thought this was interesting. So the close price to list price. So the ratio of what was the sales price when it closed versus what it was listed at was 100.6. Highest it's ever been. It's only been above 100 like 3 times in Houston. So it was still, for the slowdown, things were still selling above list price on average, to say nothing of like the really good properties, right? So you're going to have some folks that just throw stupid numbers out there and they have to come down. But on average, over 100% of list price was what you actually got.
I think there's two big pieces of data that people need to take home here. One is, look at the difference in median and average sales price over a year. It's 50 grand. If you did nothing but bought a house last year, boarded the thing up, you made $50,000 in a year.
Yep.
Like, now, again, that's the median. So meaning some houses experience greater appreciation. Let's talk about the months of inventory, because that's where things get really interesting. I chatted with Mark Dotsauer one day. He was the, you know, head of the Texas A&M Real Estate Center, a really sharp guy. He said price reductions start at 10 months of inventory. And in the price point I imagine that investors are buying at, which is below $300,000, the amount of months of inventory is like 3 weeks. So investors that are worried about a crash, I'm like, explain to me mathematically how that works. Because we need 10 months of inventory, we have 1.4.
So really, just 10 months, huh? That's the number where you start seeing price reductions?
Yeah, so in new construction, it starts at like 6 or 8 months when they start doing price reductions. But in existing homes, it's about 10 months. Now, you can't really take like the whole city. Like Houston's so big, you got to look at it like market by market. So if you start to get into a submarket where there's 10 months of inventory, you're going to start seeing price reductions. But, and I keep telling folks, I'm like, explain to me mathematically how that works, because we're at 1.4. And in neighborhoods below $300,000, it's measured in weeks.
Yeah.
So I'm like, tell me where we get to 10 months of inventory in Copperfield, in Sugarland, in like any neighborhood people want to be in. Tell me how we get to 10 months of inventory, because sure, mathematically it's possible. Maybe aliens fly down. No, you know what it is? It's like Thanos comes in with the glove, snaps his finger, and half the population's gone. Okay, now we got 10 months of inventory. So it's, yeah, I just like, the numbers just don't make any sense. Like, we've got to build a lot of houses, and there's got to be a lot of people that get thrown out of the real estate market in order for those inventory numbers to come up. Yeah.
For the people, if you don't know, 6 months of inventory is considered a market imbalance. And basically what that stat means is that if there were not a single other property that comes on market, if we just stopped listing homes, how long would it take for everything to be depleted? And it would be gone in less than 2 months. A month and a half, we'd be sold out of everything.
Which, if I'm not mistaken, Jeff, 1.3 or maybe it's 1.2 is a record low of all time. Like, I think it's 1.3, 1.2. It's never gone below that. And we brushed on that record. It blew through it last year. So it's insane. It's actually, what it really means is the housing market is really unhealthy, because God forbid, I mean, you guys work with retail buyers, right? So here's a family, they got to sell their house. Now they got to find the next house. And it's insanely stressful for them to go find the next house because they're going like this.
Yeah,
So it's actually a very unhealthy market, truth be told.
yeah. Last month it was at 1.3, so it's been hovering around that for quite some time.
Crazy. So jumping into San Antonio, I do want to say that we are hiring in San Antonio, Houston, Dallas, and Atlanta. So if anybody that's listening on is interested in joining the team, definitely feel free to reach out. We'll have our contact information at the end. Now in San Antonio, sales looks like it's come down 8% from last year, and prices have gone up 20% since last year. So the lower inventory is, continually causing the spikes in the prices. Looks like days on market are down 18%, and homes are continuing to, fly off the shelf. In regards to rentals, you can see that there is 14% more rental closings. The average rents are up 14% from last year at $1,587 is the average rent in San Antonio, up to $1,805. And as rents have increased, the time it's taking to rent has increased by 6%, which is minimal. It's 2 days longer to rent today than it was last year.
I don't know if you have an opinion on if you do many deals in San Antonio or know much about that market, Jason. The part that I never quite get, and to your point earlier though, like markets have different numbers. Houston, we're feeling pretty good about ourselves. We're at 16.5 median increase. San Antonio is chugging along at 23. I mean, that's a big number. But look at the rents relative to the home prices. So your average rent is what, $1,800 a month. Your average home price is $395. Like if you look at Houston, average home price is $420, so a little bit higher, but the rents are like $2,160. So there's a huge, what I think is a pretty significant difference in what you can collect in rent in Houston relative to the price you got to pay for the house in San Antonio. So it leads me to believe that Houston's a little bit better market as far as for landlords, but I'm not quite sure why. Like I don't know if you have an opinion on why San Antonio rent will be lagging a little bit, but it's catching up. I'm just curious.
Part of the problem with Houston, there's a reason that Houston is not in the Case-Shiller index. The Case-Shiller is a big 20 composite marketplace. San Antonio's in it, Austin's in it, Dallas-Fort Worth. The reason Houston is not in the Case-Shiller index is because it's the largest real estate market in the country. So if you look, in San Antonio, they sell 3,300 homes a month. We sell 11,000. So the problem is, if you were to put Houston into the Case-Shiller index, it would completely skew the data. So they had to take it out because it's just too big. Because it's so big and the data set's so large, you like when you say like, hey, the rents are a lot higher relative to San Antonio, it's like because the data is so big. So what you really got to do is kind of break it down in segments where landlords operate. Because a certain percentage of Houston has more $1 million homes, but Houston's also so big from the greater MSA, we drag in like a whole bunch of random little markets, right? Like we go as far as Beaumont all the way down like Surfside and Freeport and all that stuff is actually considered part of the Houston MSA. So you start dragging in all these like little markets. So it makes it look like our rents are a lot stronger. I would imagine San Antonio is an even better landlord market than Houston is because and this is just my guess, I've not looked at the data, but there are probably more homes available to landlords at cash flow than would be here. And so one of the things I've said, we've not talked about the 1% rule yet, but Houston's on its last legs for a cash flow city. Because it's going to turn into Chicago, where nothing cash flows here and you're buying on appreciation. San Antonio, followed by Corpus Christi, will be the last markets in Texas that will allow you to cash flow for maybe the next 10 years before values just outstrip rents and you just won't be able to cash flow in this marketplace.
So are you guys, so if that's what you think, are you trying to teach your people to go into like maybe more tertiary markets where it's not so cost prohibitive to cash flow?
Oh, absolutely. 40% of my portfolio is in Corpus Christi, and we started doing that 3 years ago. We saw the writing on the wall 3 years ago, and it was like, hey, we're just going to skip San Antonio. We're going to go right to Corpus Christi. And that market has been absolutely on fire. So, but yeah, we tell folks, look, Texas is a great market. Doesn't matter where. As long as the cash flows, buy it. But if you're trying to build a bigger portfolio a little bit faster with better cash flow, that's when we started adding Airbnb to our portfolio and our funds. And getting into Corpus Christi because there's just that much more cash flow.
Gotcha. All right. Next, we're running out of time. We got like 10 minutes left. We just have a handful of slides, but I want to give some time for any questions or if Jason had any closing comments. So we'll try to go through these last few slides a little faster. Dallas, so this is not Dallas proper, just to be clear. This is North Texas, which is a huge area. I think if this were just Dallas, you would see a much higher numbers as far as the price goes. But again, median price is 350, up 20% a year over year. They include a little market share, like the biggest share of homes, or I guess segment of homes in Dallas is the 200 to 300 range, 24% of the market. Active listings are up 4%. Closed sales are down 3%. Days on market 30. And then again, look at the months of inventory. So it's kind of the same story, just a little bit, everything's a little bit more expensive. I don't have rent. I can't get rent data in Dallas. I don't know if there's a place that maybe I'm just missing, but I can't ever find rent data in Dallas. But I got to believe it's tougher to cash flow in that market than maybe say Houston or San Antonio or Corpus. But the months of inventory 1.3. So it kind of goes back to what we've been talking about. There's just not enough for sale relative to how many people want to buy. You do any deals in Dallas up there or no, Jason?
No, I've done some stuff up there. I'm looking for to build another real estate center up there, and so I'm starting to get familiar with the commercial marketplace. But I'm looking for something between Dallas and Fort Worth. You guys, the old joke, like people from Fort Worth will travel to Dallas, but the Dallas people will never go to Fort Worth. So I'm playing that little cultural game up there. So I got to find something like in between, right? But yeah, you're right. This is the North Texas report. If you looked at Dallas, its median price is probably 20-30% more. I mean, it's a crazy market.
Yeah.
Next. Oh, there you go.
So jumping into Austin, Austin is definitely crazy as usual. The median sales price, 550 grand. That's up 19% year over year. You can see closed sales are actually down 30 to 3,280, which is down 6%. The average days on market is 18 days, which is no change from last year. You can see new listings are right at the same. Now the active listings and the pending sales, active listings are up 52% and pending sales are down 5%. I know that we were talking on that earlier, Jeff. Well, I'll go over the last two stats and then I wanted to just cover that. Total sales dollar volume is up 11%, and that's of course with the increased pricing that you're seeing. And then the months of inventory it currently is 0.8 months, which is up 0.3 months from last year. So, which is a pretty big percentage jump if you're looking at it that way.
So Jason, you were saying earlier that the Houston market is unhealthy. Then I would, if that's your reading of the situation, then this one's got to be on life support, right? Like 0.8 months. That's better than it was a year ago. So, if nothing else hit the market, every house will be gone in less than a month.
Yeah, this is Southern California here. Like that's what Austin is. So, like you could take these stats and throw them out the window because there's just so little supply. Like it doesn't. It's like, when you start doing big data sets, it's one standard deviation from the mean is called sigma. So this is like 4 or 5 sigma from the mean. So whatever you use to analyze the marketplace, just throw it out the window because these numbers don't even make sense. Like there's so little supply for so long. Like, you could have 52% active listings because guess what? They're gone in 3 weeks. Like exactly. It's so bananas. It's just crazy.
All right, next slide. So,
really
hey, Destiny, welcome back. So this is something we cover every meeting. I thought it was interesting. I want to get your take on it, Jason. So the affordability index, and it's basically it's a measurement of some basic stuff, but it takes the household income, and then it measures that relative to the average home price, the average mortgage payment, and so it's basically how much of the average citizen's income would go towards making the average citizen's mortgage payment. And so, for example, in Miami, the average income is $44K. The average home price is over $600,000. So those two numbers don't jive that well. So it would be over 80% of your income would go towards your mortgage payment, and then it goes down from there. a few things. On the right, I found this interesting. Of the top 20 markets, so this is least affordable, 12 of the 20 are in California. And all of them except for Austin and Reno are coastal. So there was some in Florida, some in the Northeast, all on the left coast as well. Austin and Reno were the only two that were not in a coastal state. If you look down, Austin's in the top 20. It's 18, like you said. It's competing with Southern California at this point. Houston up to 25. Houston is less affordable than Dallas, which I thought was interesting. But there you go down there, number 61, Jason, Corpus Christi. The lower down on the chart, I got to believe the better it is for investors to still get good deals, the cash flow.
So I've always had some problems mathematically with how they calculate this, because the people who are, real estate is what's called, it's transactions on the margin, meaning who's actually buying houses. Most people in Texas cannot afford the house in the neighborhood in which they live if they had to buy it today. That's how much appreciation we've had. But they're not buying houses in their neighborhood. Who's buying houses in their neighborhood? Folks from California. So when we talk about affordability index, only 3% of real estate is ever on sale at any one time. So who cares about who makes what that already lives in the marketplace? Who's actually buying the homes? There's a great chart that the Federal Reserve puts out through the FRED database out of St. Louis. And it's called it's mortgage payments by percent of disposable income. And I'll send it to you, it's in that PowerPoint deck I have. So it's mortgage payments as a percent of disposable income. It's never been lower. So when people tell me that real estate's not getting is becoming less affordable, I'm like, well, what's the percentage of the mortgage payment relative to disposable income? And when you look at that, it is clear why real estate's getting so expensive, because it's not really that high. Like I said, I'll shoot it to you in that PowerPoint deck I've got.
Please.
Yeah.
But I read a thing the other day that said, like as a percentage of income, because I'm very curious what you're saying. As a percentage of income, mortgage payments have not been this high since like 2007, I believe. So I don't know. I'll try to find that stat. Maybe there's some way they're playing with the numbers that makes both of those statements true at the same time. So I'd be very curious to hear to see what you're talking about.
Yeah, and a lot of this stuff you got to like dig down into the math to figure out how they calculate it, right? So they start throwing some weird stuff in there, and you're like, well, wait a minute, this, because you start talking to people, and you're just, this doesn't like make a whole lot of sense. But when you start really kind of digging, the problem is, like I said, sometimes these data sets get so big, but real estate is done over here, right? 97% of homes are never on sale. It's just this little 3% here, right? So
that makes a lot of sense, because you think about it, like how in the world does anybody in Miami ever buy a house? But to your point, not everybody who lives in Miami is buying a house. They already live there.
We're shopping for one, that new condo complex 11 that has that big club in it and all that stuff. We're going to put one under contract pretty soon here, and we're in the 600s for like a 1-bed 400 square foot. I mean, it's like a little box, right? But we're crazy real estate investors from Texas, right? So who else is buying in Miami? A bunch of folks from New York. It's not folks that live in Miami are not buying those sorts of properties, right? It's folks typically from out of state.
I guarantee you, Austin just wrote down that club number and club name. He'll be there. He'll be there next week.
100%. Take notes.
Remind me. I'll send you the intro video for this place. It's bananas, absolute bananas.
Sweet.
All right,
awesome. I'll cover this last slide pretty quick. So as I mentioned at the beginning, we have a conventional short-term rental program. So those of you who are buying Airbnb properties, VRBO, I'm just going to describe how this affects you as an investor. So traditionally, if you had a single family property, many lenders will require you to get a lease in place before you can refinance. We do not require you to have a lease in place for a regular single family property, because we can use the market rent to offset the debt. Now, whenever you get into much larger properties, such as $700,000, $800,000, $900,000 houses, the market rent in the area is not going to support, is not going to be above what your payment's going to be. So with this program, we're able to take the market short-term rental data to offset your monthly payment. So even if your payment's $5,000, $6,000 a month, we're going to look at other short-term rentals in the area and use that income to offset the debt for you to still qualify for a conventional loan, which is a huge deal. Now, just one stat I want to cover is cash flow for the average rental. The short-term rental is 61% more than a regular rental. So those of you who aren't yet in the short-term rental space, it's definitely something to check out. And now you have a conventional loan option that you could get qualified for.
Yeah, I mean, if you think about it, just if most people's debt ratio is fine, but if you're going to go buy a big fat, $700,000 Airbnb, then that might stretch the limits of your debt ratio. But with this program, you don't have to worry about that. We can use the short-term rental rates from a couple different sources that will offset that payment, so you can qualify and diversify a little bit, get into the nice little Airbnb space. But I believe that's it. That's all we got.
Yeah, and we are over time. So for those of you that don't have questions, feel free to hop off. I am going to announce our winner though right now. So wait 1 second. I spoke too soon. Our winner for today is, I lost it, Keisha Gerardo, and I am so apologetic if I mispronounced your last name. Congratulations, Keisha. You are the winner of the half off your hard money processing fee with Catalyst Funding. I will reach out to you via email, giving you a certification, letting you know. If any of you have questions, write them in the box. We won't take up too much time because we are a little behind, but we will ask a few of the questions. And for those of you that are interested in reaching out to Jason, learning more about Mr. Texas Real Estate and his mastermind group, or even just tuning into his radio show, his contact information is on the screen, so you can check out his website there, reach out via email, or you can give him a call at the number on the screen. Awesome. Well, again, we want to thank all of you so much for joining us, and we will jump into questions. This one came in very early when we were covering our Catalyst, Jiminy Crickets, what do we name that slide? I make the presentation, I don't remember.
Yes. Value proposition.
Yes, our value propositions. Apologies. This question is for Jeff or Austin, and I'm not sure if you want to answer on the call, but this one is, what are our non-QM rates? I don't know if this is a question we can answer vastly, but.
That's a great question. It's right where conventional interest rates are. You're paying points anyways on conventional loans right now, and our non-QM rates are right at high fives, low sixes.
Okay, awesome. Thank you. Let's see. I'm seeing responses to some of my responses. Let's see. What do the shaded vertical bars mean? I believe that was from one of our, I believe that was
Jason answered that question.
Yeah,
okay,
those
go
are
ahead.
recessions. So the gray bars are recessions. So whenever you look at any of the data that comes out of the Federal Reserve that looks like this, that have years on it, so the shaded bars are recessions. So a recession is defined as 2 consecutive quarters of negative GDP, gross domestic product. So those gray bars are what the government deems recessions.
Yeah.
Awesome, thank
Just
you.
for a little context, so they just real fast, those are like starting from the left, that's got to be like 73, 74. The little skinny one is late 70s, and that's the early 80s. The next one is like 89. Next one's 2000, and the next one's 2008, 9ish.
Awesome. Our next question, can you please explain cash flow market? I don't get the Chicago comparison.
So the real estate in Chicago is so expensive that the rent will not cover your principal, interest, taxes, insurance, maintenance costs, all that stuff. It's called negative carry, which is how investors invest in Chicago, New York, and LA, and some markets in San Diego. So what they're doing is they're negative cash flow, but they're selling in the future on appreciation. So that's how that works. Houston will eventually be that kind of market. So will Dallas. It's just a matter of time. So
is it safe to say Austin is already there?
Oh, Austin's there, yeah. I don't even include Austin and Texas anymore. It's just a crazy market, but yeah, Austin's there.
Now you can't, I don't know, but like I think you can get some duplexes and it's 2 to 4 units and still cash flow a little bit in Austin. But as far as just regular single families, yeah, you got no chance.
Yeah, you're not buying single families that are cash flow unless it's literally in a war zone.
Awesome, thanks guys. Okay, I have one more question unless anybody writes one in while I'm talking. This question is, demand from investors should be going down since rates went up, right? Question mark. I think they're looking for some clarity here and your feedback on what you think.
No, investor purchases are at all-time highs. They make up almost 30% of the market. Here's what's crazy. 30% of the market are investors and nearly 30% of the market are cash buyers. So why that's important is for 2 reasons. One is the millennial voting bloc is the largest voting bloc since the baby boomers. One of the reasons we had the 2007 crash, Jeff, I think you and I are about the same age. We're Gen Xers. Our generation is really small. And we were doing what's called household formation, which household formation means you're dating somebody, she gets tired of living in, the high-rise apartment down in the Heights, and you need to, quote, grow up and go buy a house. That's what household formation means. And then at some point you're having kids and all that stuff. So our generation was really small. So we hit the 2007 financial crisis. The reason it was so bad in real estate is because we weren't growing up and buying houses, or we were, but our generation is so small. One of the reasons you're seeing such pressure on real estate right now is because folks like, I assume like Austin's age, are now having to grow up and buy a house and start having kids and all other stuff. That's called household formation. The problem with that is now these millennials, who are one of the largest voting blocs in the United States, can't buy houses because evil, rich real estate investors, like everybody on this call, keep buying real estate at all-time highs. 30% of the market is investors and another 30% is cash buyers. Now let's talk about cash buyers. The reason cash buyers are so important is when you have cash buyers that enter an asset class, that really means the asset class is at a bottom. So this is what a cash buyer does. They walk in and say, I'll buy everything for cash at this price. That technically means you're at a real estate bottom, which is weird because we're at all-time highs. But when cash buyers step in, that's how you know you're at the bottom of a marketplace. And so many investors are buying. So no, the investor marketplace is growing. And that's going to be a huge problem for us in 2024 because it's going to turn into an election issue. They're already talking about in Dallas putting together an anti-flipping rule. So get ready, guys. They're coming after investors because millennials can't buy houses.
They can vote though.
Yeah, we talked a little bit about that at the start of the pandemic because Jeff and I found that we were at the age of home buying, millennials, and that there were the largest population. In addition, we found, man, we should have had that graph on here. But I guess we didn't know you were going to get this question, how home builders have dropped. Jeff, do you know what I'm talking about?
I do, but for the record, I am not a millennial. I don't know, the way you said it, it sounded like I was a millennial with you. I was like, no.
No, I'm the millennial. I think, Austin, you're a Gen Z, right?
Y'all are close enough.
I'm 37 with 3 kids. I know I look young.
I think that's a good stopping point for us. Jason, thank you so much for joining us today. It was an absolute blast. Our attendees held on a little bit longer than usual too. We haven't normally a big drop off right at time. So I think they really enjoyed having you on, and we just want to thank you everyone for joining us today.
Great, thanks so much for having me on. And I already emailed the presentation to you guys, so it should be
I already saw it. Thank you.
Okay,
Yep.
cool.
Appreciate that.
Great. If you guys want that are joining us on the call, shoot us an email.
Thanks everybody.
All right.
Thanks, Jason.
Thanks, guys.